Let's welcome on board Anand Tandon then. Anand, hi morning. Can't help not talk about realty. What a fabulous reporter, number coming in from DLF and the kind of rub-off it had on the rest of the realty pack as well. I mean, everything from an Oberoi Realty to a Godrej Properties, they were all zooming up yesterday. Still a buy?
For some time, yes. I think what we've seen so far is that top end of the market has not had any major impact negative. It's the bottom end which has reported problems, and you've seen that across the board in, for example, FMCG, etc. The numbers have not been very exciting in the year one past. Going forward, however, we do expect some of that change as we expect, rural India to pick up in the current year. But the top end will continue to remain fairly robust. So I would imagine that for the near term at least, maybe another 6 months or so, the demand for reality should remain fairly strong. And that would obviously be reflected in the prices. What we are beginning to see, however, is that the housing starts, as it were. The intention to set up a new project has already peaked out in most of the cities. And what you're getting now is the pipeline that has been established over the last couple of years. So, 2 or 3 years down the road, you will find that the construction volumes start to fall, and that would actually mean that the demand has to fall off a little before. At least that's what the market seems to be signaling. But at least for the next 6 to 12 months, I don't see any.
So which one would you buy? DLF, Shobha, Macrotech, or all three?
So I think I would actually bet most on Bangalore because among the listed players, they are the ones that are most well represented. Actually, Hyderabad has been doing reasonably well as well, but again, the prices have gone up to a level where I would imagine that they will stabilize from here, and they need to spend some time in this range before they come down, before they start again. And to that extent, Bangalore remains relatively cheaper than most of the other metros, especially larger ones like Bombay. So all the players that are based out of that should do reasonably well.
Where can one go fresh long on realty?
So, I mean, out of the three names which Nikunj mentioned, I'll pick one, DLF. And I think there are other stocks like Oberoi Realty, which I think looks very strong. The stock has shown a lot more consistency in the last 2 years, 2.5 odd years. Godrej Properties is making a comeback again for itself, breaking past about the 200 DMAs. The stock was beaten down more than 50% from the 2021 highs. Was one of the first real estate stocks to get into a very sharp correction from 2021. So which means that on the way up, the stock would take its own sweet time, but then the recovery could also be quite strong for Godrej Properties. So I would stick to these large cap, the F&O names from the real estate pack. DLF would be the first preference, followed by Oberoi Realty. From the non-F&O space, Anantraj Industries is something which also looks very attractive. The stock has consistently shifted range from 70, 75 earlier to 100 plus, and from those levels to now, I think at 140, 142, where the stock closed yesterday. So these are the few names which I would be looking out for, and extremely bullish specifically on DLF.
Okay, a lot of other stocks which are going to be in focus. You just heard from the HPCL management as to how the GRMs have been very, very strong. The visibility, the fact that they are looking at listing their lubricant business as well within this fiscal itself. And ONGC and Oil India too, considering the windfall tax on crude petroleum has now been reduced to nil from the earlier 4,100 rupees per ton. So these two are going to be stocks which are going to be in focus. And then I'm not sure how invested you are in OMCs, or whether do you even believe in investing in this cluster.
So the energy space is certainly something that is of interest. The only problem is that because of the government intervention, it becomes a little difficult to predict. That said, as you mentioned, HPCL has reported sterling numbers, especially in terms of the marketing margins. It's been way more than expected, and overall, therefore, they have reported very good numbers. If they were actually to reach anywhere close to the 12,000 crores that the gentleman earlier mentioned, then the stock per se will look reasonably cheap. So, to my mind, gas is the place to be, because that's the place where later in the year, as the winter sets in most of Europe and North America, again the prices have a potential to spike quite hard, because while oil is more directly linked to how far the economy is progressing, gas to some extent also is a matter of the climate. So, the gas prices are the ones that are something that you will need to watch out for, and therefore anybody who's a gas producer like GAIL or even ONGC or any of the others which have some kind of gas availability, is something that I would be more bullish on going forward. That said, the near-term cycle for refining also looks reasonably good.
So, what's been your portfolio strategy, Anand, of late in this market?
So obviously, the one way to look at it is that Reliance has everything. So you should just, first of all, and being an index stock, you need to be in that. The rest of it, HPCL looks to me quite attractive, largely because earlier there was that buzz that BPCL would be divested, and therefore to that extent the valuation gap between the two could possibly narrow. Even now the valuations for HPCL are far cheaper, so that's another stock that you may want to look at. And as I mentioned, GAIL seems to me to be something that can be looked at in the longer term. If you want to be a little more adventurous, then something like a GSPL, which has both Gujarat Gas under it as well as its own industrial business, gives you a mix of both consumer as well as institutional business, and therefore it's a fairly hedged portfolio.
Mine is energy. I mean, when I say what's been your portfolio strategy, I'm referring to the aggregate portfolio strategy, not just about energy stocks.
Well, the overall portfolio, if you look at it, clearly for this year, while I think the margins for most of the banks have peaked, you will have to look at financials as one of the largest areas that you have to be in, because that's where the earnings are going to come from. You are already getting signs of a significant uptick in terms of auto demand, and here I would argue that the Bajaj Auto has performed very well in the near term. You might want to look at Hero, that has been less of a performer, looks reasonably attractively priced, and as I mentioned, is a good play perhaps even on the rural area, besides the fact that they've announced that they'll be putting out new models ever so often during the course of this year. So auto is another place that attracts attention. Capital goods, to my mind, is good because the order books are strong and the earnings will come through, but they are fairly expensive. So I would be market weight on capital goods. If you look at the other parts of the market which have not done so well, for example, IT, I think it is looking like it's beginning to bottom out now. And while it is early days yet for it to move up, I think you may want to start keep an eye on it, because as and when the problems in the US banking sector actually were to be resolved, I think that's where you'll begin to see an upside coming from there. In the interim, pharma and other defensives like FMCG are places that you might want to hide.
Anand, the other category which has come out with stellar numbers has been the paints category. Of course, the crude cool-off benefit as well got embedded in this quarter. But be it Asian Paints performance, or I'm looking at Berger's performance as well, the gross margins have expanded 90 basis points. EBITDA is higher roughly by about 6.5%. A space you're liking?
Well, obviously, both these companies have performed dramatically over the last many years, bar a few quarters here and there. So it's a consistent performing kind of space. But the valuations leave me grossly uncomfortable. While there was a bit of a hiccup last year when a whole set of new companies announced that they will be getting into the paints business, the market perhaps overreacted a bit because it takes a while for them to make an impact in the market, and that dropped these stocks. But I think the market has quickly got over it. And the problem is that, again, the valuations look highly stretched to me. So at this stage, it's not a position that I'd be holding in any significant size.
Okay, meantime, wanted to get in your take as well. I don't know, Anand, if you had a look at PVR Inox's numbers, and we did flag off just earlier today that the higher than expected net loss was due to a series of one-offs, and a lot of the operating metrics like spends per head or average ticket prices or even the advertising revenue came in much below what the street was expecting, which is why you saw that EBITDA loss this quarter. Have you had a look at the financials?
So I don't track that anymore. I think that's now a space which is going to be permanently damaged by the TOT that has come through. While people don't think that you will have people getting back into the halls fairly soon, the question is there is also quality lack in terms of the content that will drive the earnings. So unless they find a new model to get people into the halls, I'm a little skeptical of their ability to kind of get the same kind of growth that they were reporting before the COVID. So for now, I would stay away from that sector.
Yep, and bad movies as well.
Yeah, the content pipeline, they're saying so themselves. The fact that the Hindi content has been below par, the fact that Hollywood releases have been fewer than expected. Regional has done well, but it hasn't really made up for it, Aisha. Okay, that aside then, let's get in a view, Naresh, from you then as to what the outlook is on some of yesterday's movers in trade. Just taking a sense as to what really stood out then within the the broader markets as well. And just allow me, sorry, to refresh my screen there. Okay, so let's get in a view as to what really stood out. Apart from, of course, real estate, you had names like Zensar Tech or an Ujjivan, Polyplex Corp. Those stocks surged. Naresh, your view on the charts?
So Zensar is another example of what has been happening in the mid cap and small cap IT names. We've seen one by one the mid cap and the small cap IT names go up after the results. So Zensar has done the same. The stock had corrected also a lot from a high of almost 550, 600. The stock came all the way down to 220 levels. Recovery has been strong. Volumes have been good in the last 2 days. It's just that the risk reward is no more great. But dips back to 330 to 360 zone would be a buying opportunity. So positive on the stock for the medium term. It's just a stock to be bought on dip. Ujjivan is something which I recommended yesterday. The stock looks very promising for the fact that the stock is available at the same prices where it was in 2016, available at the same prices where it was in 2019. Now, after the big crack in 2020 Feb to March, during COVID, the stock fell to 150, 170 levels, came back to the same prices in March 2022, and then it has made a steady recovery from those levels. Went back to 300, 320 zones, which was the high in 2020 in. And this is where it's making a huge cup and handle breakout. The breakout is done, and going forward, it's a buy at current levels also. I would expect it to slowly and steadily go towards that 420 mark where it was before the pre-COVID prices.
Okay, just looking at a couple of buzzers yesterday, and Kunal, how can we not talk about what was going on with the Nifty Bank? Unfortunate as it may be, left behind by what, 10 paise? Yeah.
10 paise.
Yeah. But you know, I think the intriguing thing is that it was not a broad-based participation. ICICI Bank closed in flat. Barely any move for an HDFC Bank or Kotak as well. They were less than 0.5% a mover. What are you making? Where is the strength really coming in from within banks?
No, so I think it's collective move from most of the banking names and large cap banking names. So, I did a comparison from 14th of December to 15th of May yesterday on how the movement of Bank Nifty has happened and which are the stocks which have actually moved up higher. And it's intriguing because the likes of HDFC Bank, ICICI Bank, they are up 1% to 3% from their 14th December highs. Again, at these point of times, at current rates, they are nowhere close to their 52-week highs for themselves or even life highs for themselves. The likes of AU Bank has outperformed, CSP Bank, that's a stock which has outperformed. But most of the other names, the PSU banking pack, the likes of SBI, Yes Bank, most of the other banking names, even Axis Bank and IndusInd Bank, they're significantly below their 14th December highs. So which means that the move is more powered towards large cap names. So what happened in December 2022 or in the fag end of 2022, it was more PSU banking stocks which were leading the charge. Right now, the move is more formidable towards large cap private sector names. And that's where I believe that the context is that in December, the markets were looking a bit more frothy, or the move for the bank index was looking a bit more frothy because of the way the PSU banking stocks were moving. Right now, the move looks to be more stable because the large cap private sector banks have started to participate one by one. So I think that's the change for the bank Nifty texture. And that's why I believe that the move could be sustainable, as well as hopefully we'll get the breakout this time around.
You know what is banks near 52-week high, SBI 8%, not sure what this graph means actually. Because SBI is not at a 52-week high. Please take it out. SBI is not at a 52-week high. That I'm reasonably sure because SBI is, from last December, SBI is down 3%. So my apologies, we'll fix that data. Anand, the call for PSU banks in 2022 was they were cheap. NPA cycles had bottomed out. Credit cycle had started. They have strong CASA. And you can only lend if you have cash. And that's how PSU banks came back, whether it is SBI, BOB or Union Bank. Low NPAs, strong CASA, strong credit growth. And they benefited because of that. Do you think this is yesterday's story or this is still tomorrow's trend?
Well, the themes that you mentioned remain. The question is which of them will have the highest ability to get liabilities cheap. Given the fact that to some extent it looks like there is an interest rate pause, it becomes a little less of a issue. But I would still retain, if at all you want to be in it, I would think the largest banks are the best. Having dealt with public sector banks for a long time, it appears to me that some of the smaller banks really have no understanding of credit. And they pretty much go where the market is, and that will mean that as the market becomes overheated, in terms of and I have to admit it's early days yet, so it's not as if currently you are anywhere close to overheating. But in the next 6-8 months, you would imagine that if credit growth was to stay where it is, they will begin to build up bad credit again. So to my mind, SBI is the king of the lot. There is no question, both in terms of size as well as in terms of their ability to understand credit. Bank of Baroda is possibly good. Union Bank always has had some amount of presence in NRI segment, etc., and therefore does reasonably well. But otherwise, I would not go too far down the curve, though there are some opportunities like Canada, etc., which on the valuation basis look fairly okay. But it's much better to focus on high quality public sector and private sector names at this stage. That's where you'll make the best in terms of the portfolio on a risk return basis.
Colgate Palmolive. Yes, I'm saying Colgate. When did we last discuss Colgate? Should we discuss it? Because yesterday's volume
Yesterday
action
when the numbers came out, we
was
discussed.
six times more than the 10-day average.
Yeah, there's a different change for FMCG. In fact, FMCG was the first sector to make a fresh 52-week high in this last 1.5 odd month. It was then followed by auto index, and now we are on the verge of Bank Nifty making a new high. And I think even from the FMCG pack, Colgate, after yesterday's move also, I think the stock is some 8% or 9% lower than its previous 52-week highs. HUL, Dabur, these stocks have underperformed from the entire FMCG pack. It's the likes of Nestle, Britannia, which have actually done exceptionally well. ITC, of course, is the other stock which has done exceptionally well in the last 1.5 odd year, or as well as in the last 1 to 2 months of this strong price recovery. So it's a different mix, as I said, Nikunj, for the entire sector. For various sectors, you don't have the traditional stocks which are moving up higher. You have a different set of mix this time around, and same is the case with FMCG names.
Right, okay. Let's get some mid-cap ideas going as well on that note. And Naresh, what's on your mid-cap radar?
So that would be a buy on L&T Finance Holdings. The stock is finally on verge of that 1.5 year, 2 year breakout. The last time also it faltered around 95 to 100 levels. It attempted it 3 times in between November to February, corrected all the way down to 80 and has now made a recovery to 9500. This was the high in 2021, again 3 times. So it has been a multiple attempts around that 9500 mark. The indication that it could break out is for the fact that for the last a week or two, the stock has been sustaining around 95 and making a base higher. Expecting this to break out and go to the prices of 120-25 levels, which was the high pre-COVID. So a buy at current levels with a stop loss at 94 and an initial target price of 120.
Kunal, what about your mid-cap list?
Well, that's a buy on RateGain. That's a stock which has done exceptionally well. I think on 5th of May as well, I had recommended the stock with a potential target of 380, 400. The stock has crossed those 400 levels. I think at 410 plus levels, it looks attractive for another 7 to 8% on the upside. 440 could be an immediate target. Stop loss at 405.
All right, let's